my name is Andrew Twain, and I am the Managing Editor of Insurance Investor and FundOperator.com here at ClearPath Analysis. Today, I am joined by Martin Collins, Trustee Director at 2020 Trustees. Hello, Martin. How are you?
Hello, Andrew. Good to meet you.
Fantastic. Thank you for joining us today, Martin. Well, Martin will be speaking at our Private Markets Investor Europe 2023 event, which will be held in London at the end of March. So we're really looking forward to that. He will be speaking on how can investors insulate their portfolios from the impact of external drivers, including inflation, fee pressures, geopolitical changes, and monetary and fiscal policy. So a massive broad topic with lots to get into, lots of details we can chew over. So I want to dive straight into the questions, Martin, and just want to get a brief intro from you about who you are and what your role is and what you do in the financial sector.
Yeah, I have a lot of experience in this area. So I started my career as a scheme actuary. Then after a spell in investment banking, I became a Treasury Director at the UK's biggest bank, Lloyds Bank. As well as hedging bank risks, I implemented all of these hedges for a £40 billion pension scheme. So I've been at the cutting edge of actually doing this. And now, as a professional trustee for 2020 Trustees, we are the trustees to 212 pension schemes. So we see a lot of what's happening across the landscape in UK pensions.
The 212 schemes, so a drop in the ocean, basically. I want to dive into the nitty gritty of what we're going to talk about. So. The 2023 outlook, what are the big external drivers that investors are experiencing this year, and what are we going to see in the market?
Yeah, it's hard to talk about 2023 without talking about what happened last year, because it was a huge year in UK pensions, particularly for this area of risk management. So just for a bit of context, most pension schemes have been hedging interest rates and inflation risks to some degree, a very large degree, for many years. And generally, how they do that is they allocate a portion of their portfolio to what we call LDI, and that's largely in the UK. It means buying index-linked gilts and some fixed interest gilts, and then borrowing against that in the repo market. In that way, they're not using all of their assets to do the hedging. So that way, you can hedge pretty much all of your rates and inflation risks in the scheme with only using about a third of your assets historically because of that borrowing. And then if we go on to the sort of the outlook. What happened last year and is continuing is we saw a very, very dramatic rise in government bond yields, as well as a big inflation shock that we've had. So after a decade of very low inflation and long dated interest rates below 1% even at times, historically unusual. We've had in 1 year a dramatic unwinding of that with a massive inflation spike, and in the UK. Long-dated gilt yields started the year at 1% and peaking at over 5% at one point. And in part, that's a global phenomenon. So that's happening around the world because governments are starting to having to repay not only the huge amounts of borrowings that they built up during the COVID pandemic, but actually there's a lot of quantitative easing from the great financial crisis that still hasn't been repaid. And the UK is starting to pay that off as well. So because of supply and demand, when the governments are now issuing a lot more bonds, that was already pushing up yields. With that spike in inflation, suddenly, most government bonds are not index linked. So inflation makes those relatively unattractive. So that pushed down prices, which pushes up yields. So as I say, we saw this dramatic spike in yields around the world. But we had this extra issue in the UK. We had a political crisis. Where the new government decided it was going to cut taxes dramatically to boost growth. That led to a further spike, hence the one up to 5%. Yeah. And that spooked the markets to such a degree that government only lasted for I think 40 days and had to get replaced to backtrack on that. So really dramatic politics in the UK linked to markets and pensions. What this exposed in the way that we hedge against these risks in the UK is quite dramatic fault lines in terms of operational risk, in that this borrowing that we've done for many years was always secured against the government bonds that you were buying with the borrowing. And we've got a quite nasty feedback loop that as this political crisis happened and bond yields rose much faster than everyone predicted they ever could, been described as a 1 in a 400-year event. But because of this feedback loop, it really spiked up. that some pension schemes were forced to sell the gilts so that they could meet collateral calls on the borrowing, which pushed yields up even higher. And so we got into a very nasty feedback loop. Bank of England intervened, which is unprecedented. And I say the government collapsed, again, unprecedented in the UK. So all of that, we've learned a lot of lessons in the UK about the limits of the use of leverage, how quickly you have to be able to provide collateral at a time of crisis. And I think, although that's a UK specific issue, I think people watching from other countries should look and learn from that and review their own arrangements. How will you deliver collateral when you get collateral calls if the same crisis happens in your country, because it could happen elsewhere. So all of that is quite a long answer, sorry, but in terms of the backdrop, so in terms of the outlook, we've still got a very high inflation. We've got dramatically higher government bond yields. So they've come back from the highs of the political crisis to under 4%, but it's still not far below 4%. As I say, beginning of last year, they were a bit over 1%. So that's dramatically higher. And given the amount of government borrowing that's going to happen in the future, we're seeing further pressure on bond yields. So at the same time, the fixing we're having to do to stop getting another collateral crisis happening in the future means we're basically borrowing less against the gilts that we hold in our LDI portfolios, but that's making it take up more room in our portfolios. Also, the change in government bond yields, it dramatically changed the valuation of many assets. So many portfolios are looking in a very strange place, with the liquids suddenly taking up, a lot more than was planned in portfolios. So there's a lot of pension schemes in the UK having to look at how they fix that now. And again, and that's in the context of higher bond yields, high inflation.
Yes, 2022 was the year that just would not let up with the financial and economic and political crises. So that kind of takes us on to our next question, which is how do we insulate ourselves from this happening again? So what are some of the steps that you would recommend to members of the financial community to insulate their portfolios from these effects of various government changes and inflation and these other effects?
Yeah, I mean, most pension schemes have been looking at how they manage these risks for many years, and in terms of how they invest their assets as well for very many years. So I think there's a temptation when you look at investment strategy to tweak it a bit, or to think about themes that are troubling you. For example, governance concerns about investments in China is a big one in ESG space, for example, and make adjustments for that. What we're seeing in the UK is the change has been so dramatic to the way in which we're going to manage these risks going forward, that it's changing dramatically the costs of doing that hedging, how you structure the portfolio. Increasingly, we're seeing we're having to do drains up investment strategy reviews and start from scratch. There are limits to how quickly you can change your portfolios, though. There are big costs, for example, for selling liquid assets potentially, particularly at the moment where a lot of schemes are having to sell liquids. So it's quite a bad time to be doing it. That said, when all the costs change dramatically, the most efficient answer is probably very different to what it was a year ago. So lots of restructuring of portfolios happening. So generally a theme is holding more liquid assets, holding, and this is to cover collateral calls, is having a rethink about how much hedging to hold. Many schemes have moved to very high levels of hedging over the last few years, maybe even to 100% of interest and inflation risk. And actually now we're seeing, given that it's more expensive to hedge in terms of how much of your portfolio gets used, so how much is left for return-seeking assets, many are rethinking that, thinking, well, hang on, as part of that sort of drains up, start from scratch, maybe 80 or 90% hedged is enough, in the marginal benefit from closing out that last bit of risk, which is never total hedging because your hedges are imprecise. So you never get to a proper 100% hedge, is actually not worth it for the extra cost. Particularly in the short term, where to maintain 100% hedging, now that you're having to provide more collateral, and use more of your portfolio to do the same hedging than you used to, that might force you to sell illiquid assets at a bad time. So again, there's a temporary thinking, well, certainly as a temporary move, many have taken off some hedging, and maybe that hedging will stay off or come back in different forms. The other thing people are thinking about is whether they can put leverage into other parts of the portfolio, so that's another way to leave the hedging as it is, as it were. And the trouble is that the government borrowing against your gilts in the UK was far and away the cheapest way to do the leverage. So there are cost implications for doing leverage in other ways. So, but I think really people are rethinking how much hedging to do. That they're rethinking how to do it. Lots of thoughts about operational governance, about how you provide collateral for collateral calls within those arrangements, and lots of people found last year that their arrangements just weren't adequate in this regard. Yeah.
So speaking of these arrangements, and I want to go into more detail about this, how would you recommend for people to work to insulate their portfolios from shocks, especially to do with inflation? And I know inflation has peaked from a lot of people's opinions, but what are we seeing here, and how would you recommend strategies?
Yeah, I think the inflation shock is really interesting, particularly if you, in terms of the liabilities of a pension scheme, and it'll affect different pension schemes in very different ways, because for many pension increases in the UK are linked to inflation, but they're capped at 5% or 2.5%, and often there's lots of different tranches of pension, so it's quite complicated. So in some ways, the very high spike in inflation has a more limited impact, but it's giving trustees of the pension schemes in the UK that for the first time for decades having to think about discretionary increases. Well, hang on, in these times of very high inflation, I know the rules say we cap pension increases at 5 or 2.5%. Should we be paying more? So these are discussions that were very common in the 70s with employers. That they're new things. So trustees are having to relook at rules and think what powers they have. One of my schemes, I found we had an unfettered power without asking the employer to pay discretionary increases. So that was an interesting one. So that's a specific action. In terms of investments, most schemes had investment hedging, inflation hedging in place, so that will have helped with the spike. They would have prepared for this, because the whole point of hedging is you don't know what's going to happen. So when something dramatic happens like this, then it's helpful. I think because of the capping, some schemes may even have got sort of profits because of the capping, short-term profits from having not anticipated inflation spiking quite so high. So we're finding many different schemes in very different places. In some ways, it's kind of too late now that once you get an inflation spike, that inflation is baked into the prices of assets. So it's kind of too late to buy hedging against it. So it's more really having to think about things we didn't think were going to happen in terms of the short-term impacts of very high inflation. Is it a short-term blip? We all think so. Specifically oil price from spike and gas prices from the Ukraine war. So that will reverse at some point. The big issue for the economy is, will inflation become ingrained before that short-term spike reverses? And it can happen. We're seeing in the UK strikes and linked to wage demands, and it's all back to inflation. People want to keep pace with inflation, but that there's no income. This is an energy price spike. So that there's no income on the other side coming in, to pay for that. So it's leading to quite again unusual levels of industrial unrest in the UK. But yes. Will that lead to wage price pressures, making this becoming an inflation spiral? Because I think that's the biggest fear for the UK economy. And actually the global economy is stagflation, where we get economic decline and inflation, and that's quite uncomfortable for investors.
Well, it's January now, so by March we might know the answer. So I'll pick your brains on the day at the conference. So that takes us to our final question, which is, can you discuss fee pressures and the trend that you're seeing there, as well as what you would recommend to protect investments from those said pressures?
Yeah, I mean, this is really interesting. We've had a decade of a gradual decline in investment fees, and some of that's driven by competition, and also I think just more intelligent buying by pension scheme trustees of investments. and the consultants can claim credit as well for that. What we're going to see, I think, this year, we're going to see a lot of fee pressure for investment managers. Why is that? With this dramatic rise in government bond yields last year, that's impacted the valuation of all assets. So pretty much all assets have fallen dramatically in value. And if you look at it, and I do have sympathy for the investment managers, if you look at it, they charge their fees almost, predominantly as a percentage of assets. So they've seen dramatic falls of their income in the last year. So, investment managers are having to lay off staff. They're having to rethink their own finances. So that's got to lead to them wanting to look to put up for fees this year, as a percentage of assets. So I think we're going to see fee pressure coming. So I think pension schemes have to be ready for this.
There's so much information there. We're going to have to really race through it on the day to get through all these fantastic talking points and so much information there. So I'd like to thank Martin for his time today. He has been very informative. And if you've been enjoying what he was saying, you can see him speak for much longer at Private Markets Investor, which will be taking place in London at the end of March. He will be there doing his panel discussion on how investors can insulate their portfolios. I'd like to thank him again for his time today. That's all from me, Andrew Twain. And thank you for watching.
Thank you.